Okay, Geoff, thank you so much. I have Geoff Saab on our podcast. Low Risk Rules is the book he's the author of. And Geoff is the guru when it comes to wealth management. He's well known in the Ottawa area and also, I guess, in all over Canada, US, right?
Well, I mean, the people who know me,
The people who know you
people
know me.
don't. Yeah.
And I want to start off by saying, I know we don't usually need to say this on our podcast, but I'd like to start off by saying that everything you hear now, it is not financial advice, and it's for entertainment purposes only.
Not financial advice, correct?
Not financial advice.
Not for you.
Yes, exactly.
Just talking.
Just
nonsense.
Entertainment and fun.
Yes.
We're here to have some fun. And so me and Geoff were just talking earlier, and I wanted to ask Geoff about his book. And Geoff, can you explain the book and what made you write the book and a little bit about it?
So the book was actually a COVID project for me. And the idea behind it is taking all of the information. Like, I've got some opinions about the way the investment business works.
Yes.
And I wanted to get it out of my head and put it down on paper so that people could, I think, benefit from it. It's specifically written for entrepreneurs, people who've spent their whole life taking risk. That's how they've built wealth. And now it's about how to invest for wealth preservation. And the idea being that there's a lot of benefits to a low risk approach. And I think that it's not well marketed to people. People don't really understand it, including people in the investment business don't understand it. So I felt like it was important to communicate this to people.
Yeah. You're doing a disservice by not publishing these type of books or letting people know, hey, like, calm down, especially during the pandemic. There was a lot of new retail investors. So retail investors means like individual guys just opening up investment accounts on their banks and buying individual stocks or whatever. And a lot of people were trying to hit it big or something.
Yeah.
There was a lot of money going around, some free money going around during the pandemic that people were just putting into the stocks.
I think there's the small investor who I agree sometimes takes risks they don't understand. We were talking earlier about your buddy who's buying options.
Yep.
Options are really risky. They're really hard to make money in,
Yeah.
even for professionals. But I know that was a thing during COVID. Reddit had Wall Street bets during COVID, and these guys were buying, GameStop and worthless stocks and meme stocks, and we got things like crypto. So I think that there's that element of it. I think the small investor takes a lot of risks that they don't fully understand. But from my context, I'm talking about people who have a lot of significant wealth, who they're taking risks, but they're kind of a different view, right? They're not necessarily following the advice of a Reddit group, but I think they are following the advice of an industry that likes to sell them packages, very like elaborate, fancy stuff to them, tells them it's very exclusive, tells them that, this is for our high net worth clients or our ultra high net worth clients, and we don't offer this to just anybody. And people love it, and they line up and they line up to get it. It's expensive. It's hard to sell. There's a lot of stories just in the recent past of some of these funds that have essentially vaporized good chunks of these people's wealth. And in the meantime, the kind of boring, reliable way to make money, which is the way that basically everyone's been doing it going back to, Warren Buffett's earliest days, is just buying blue chip stocks and sitting on them and holding them. And people don't really talk about that because there's not a lot of money to be made in that. And it doesn't seem like it's special enough for the high net worth client. So it's too boring for the average retail guy because he's trying to get rich overnight. And I think it's seen as too pedestrian, too ordinary for the average investor. And so it's kind of this forgotten way to invest that, I think can produce really reliable returns over time. One of the things I talk about in the book, and this is kind of the key revelation, and it's not based on my research, it's based on other research that's been done, but basically a lower risk stock portfolio will outperform a higher risk stock portfolio over time.
Yes.
And we can talk about that a little bit more in terms of why that is the case, but it's very counterintuitive. People think more risk, more return.
Yes.
And it's true. If you buy stocks, you'll earn more than you buy if you buy GICs or bonds.
Yeah, because there's more risk in
T-bills.
stocks. And
More risk, more return. Correct. Yeah. But within that group, so within the group of stocks, that's not the case. And it's been proven across time periods and across, in different places in the world that it's the opposite, actually. A lower risk portfolio will actually outperform a higher risk portfolio. Nobody communicates this. No one really is receptive to the idea. And it's kind of like, it's the same reason that in the fitness industry, everyone's looking for a quick fix and they have the 7-day abs or 7-minute abs or whatever it is.
Those are sold out.
Versus like the idea of being, hey, I'm just going to reduce my calories and work out, and it's going to take me years to see progress, but I'll see it. Yeah. Right? That's not the message anyone wants to hear. They want the quick fix.
They want to be a black belt in 2 weeks when it takes like 5 years, 10 years.
But the reality is in the investment world, you kind of see it, right? You see the guys who are gambling often making a lot of money. We're seeing that right now, right? Bitcoin crossed $100,000. There's not a lot of really work you need to do to understand Bitcoin. I know everyone says you got to like do 100 hours of research and you buy it, but there's nothing to it. Like there's no financial analysis to it.
No, people are buying something that there's not a lot of, and that's what makes it go up. It's like that's what it is.
Yeah, and they have faith in a story, and they buy into the story. And I'm not saying the story's wrong. They could be very right about it, but I'm saying like they're not analyzing financial statements. They're not looking through industries and trying to identify the best companies or the best management teams.
They're not know who the CEO is.
Well, there is.
That's
right.
what I mean. You don't know see it.
So, it's just this scenario where you look around, and it's funny because the people who have been gambling the most have actually been outperforming the people who are, doing the hard work. That's always a temporary thing.
Yeah, it's temporary because the person you're telling, that one I was talking to you about, him and all his coworkers, they're all like bankers, and they were investing in those puts and futures or whatever they're called. I don't know much about stocks, so I could be saying things wrong. And they got it from 60 or 70,000 to like 330 or 350,000 in a short period of time, maybe a year, maybe a year and a half. And then now it's back to like 30,000.
Yeah, and I wrote about this in the book. So what I'm talking about here comes from my own personal experience too. I've done all that stuff. So, I've made a lot of money and then I've given most of it back. And you kind of learn over time. Actually, I tell a particular story going back. I've been investing going back to the early 90s. So I had the benefit of the tech boom, and I wrote it up, and then I wrote a good chunk of it back down. And I spent the next, 10 years of my life trying to search for the next big boom, like the next stock that was going to go up 40 or 50 times. And while I was doing that, I was missing out on these opportunities to just buy these very steady compounders, these boring companies, right? Because I was trying to hit home run all the time. And if you're always trying to hit home run, or you're just going to strike out all the time, right? Mm-hmm. Like you have to take the high probability shots sometimes when they're there for you. I think it's human nature for us to do that. And because of that, there's not a lot of demand for the safer way to invest. And because there's not a lot of demand for it, ironically, you can actually earn more money doing it. You have to go, when you're investing, you have to go into the areas other people aren't going in. And you think about real estate, right? If you buy into a hot neighborhood, well, it's got to continue to be a hot neighborhood. But if you buy into a neighborhood before it gets hot, now you've got real money to be made. And I think this is the kind of thing is you have to look where the mass of people aren't looking.
Yes, that's true. Or like if you get lucky in the area, rezones, and now your lot is worth whatever more. Like
there's a little bit of luck there, but there's also a little bit of skill. If you have special
if you start researching
ability.
where the city's moving, the light rail or a train or whatever, it could really help. But you were talking about when you first started investing, like in 1990, you said?
Would have been 90, like 92, I think. I turned 18 and I started to invest like the day after. I was a real nerd, and even when I was a teenager, I studied the stock market, and I couldn't wait to start investing.
Really?
Yeah.
And do you remember your first stock?
I remember. Yeah, I do.
You ever bought like the first stock you ever bought?
So my first investment was a mutual fund, and I did okay in it. It didn't take me long to buy my first individual stock, and it was Corel, which everyone in Ottawa would remember Corel. And I remember I bought it at $14 a share. They had just bought WordPerfect at the time, and
I remember
WordPerfect,
using that in grade 5.
Most people have no idea. Most people watching this probably have no idea.
Yeah, I remember WordPerfect.
Is, right? It was now it's Microsoft Word, but back then it was Word versus WordPerfect. And so I bought the stock at $14 a share, and I don't know. I owned it for a couple of weeks, and they released earnings, and after earnings, it was $9 a share. And I took a big bet. I put like a third of my portfolio in it. And I was like a daredevil. I was like an 18-year-old, fearless. But it was the best thing that could have happened to me, right? Because it taught me, you touch a hot stove and you're like, I'm not going to do that again. And that's what I learned. It was like, you actually have to do the work. You can't be just this simple-minded, you see a stock, you see an article in the newspaper. Like I read the business section every day. Like since I was, 13. So I thought I knew this company and I knew this stock. I didn't. And I think there's a lot of people like that. They're buying stocks just based on something they're reading. They're not actually doing the work. They're not looking at what expectations are in the price. And you can get in trouble that way.
People who work there were driving like not Lamborghinis, but Corvettes or whatever. going to the bank because they got paid in shares.
Yeah.
So some people got really, really rich using it. But I know a lot of people in their 50s, 60s own, and a lot of them lost a lot of money in Corel. Oh, sorry, in Corel. Is that what it's called?
You mean in Nortel is probably what you're thinking of.
Yeah, Nortel. And they stopped doing that.
Well, I think, so I again, like I was here, I lived through the boom and the bust.
So you saw it all.
I saw it all. I actually, in my accounting life, as my previous life as an accountant, I worked, Nortel was one of our clients, and we worked with their executives who were often being relocated around the world. And when they started mass layoffs, they called us in to meet with people the day they'd been laid off to kind of help them with their retirement planning and their pension buyouts and everything. And, I'm talking to people who had just lost their job and had all of their retirement savings in Nortel stock, right? So it's like, not only is the stock getting killed, but now you've lost your job too. So that to me really taught me the dangers of concentration. So diversification is important, right? Like the whole concept of the book is you only have to get rich once, right? Like these guys, they had it made. You've got millions of dollars. You've got more money than you'll ever need.
Yeah, especially back then, $1 million, it was like 3 or 4 million.
And the stock options they were granted, like some of these people they've just been employees their whole life, and they were millionaires, multimillionaires, and yet they kept holding and they kept adding, and they didn't diversify. And why would you diversify? Because when you sold the stock, it would be up 20% the next day, and you'd feel like an idiot for selling it. I know, because I did that too, right? Like I had stocks that you'd sell it, and then the next day it's up 20%. And you're like, I should never have sold it. So you learn not to sell it.
A lot of money, 20% the next day.
I think a lot of people who own like cryptocurrencies and Bitcoin today are feeling the same thing. Why would I sell? It's stupid, right? It's going up, and it's only going up. And if I sell, I'm going to end up with less money. But I think that part of what I'm trying to communicate here is if you've got an investment that's done really well, if you've sold a business, if you've got kind of more money than you will need, now let's play defense. You don't have to be on offense the whole time. You can switch, you can play defense, you can increase your odds. It's about preserving what you've got, and it's about kind of putting the constant pursuit of more and more and more, put that away. Because if you're investing defensively, it's a simpler portfolio, it's a lower cost portfolio, it frees up your mind for the things that really matter, right? Now you're not obsessing. If you're buying options, like you mentioned to your buddy, like
for people who don't know, because I
stressful.
don't really know, what's an option?
So an option is basically, so it's
an option to buy?
Take a stock. Yeah, it's like an option to buy a stock or an option to sell a stock at a particular price. So you take a stock, and it could be a really volatile stock. The option on that stock is going to be, depending on like the price at which you can buy or sell it, can be like infinitely more volatile than the stock itself. And at a certain day, the option expires. So the closer you get to the expiry of that option, if it's not in the money, is what they call it, essentially it's worth zero.
So if you're like, let's say the stock is $100 stock today, I have the option to sell it at 110. So when it reaches 110, I make $10. The difference.
If you have the option to sell it at let's use a call option because it's simpler. Let's use the option to buy it at $100 and it's 110. That option is worth $10.
Okay, so it's the opposite. Right? So if it goes down, I made a $10 swing.
So you're making a profit on the difference between the strike price of the option and the price of the stock. So as you can see, if it goes from 110 to 101, that's a $9 swing, right? That's a 90% decline in value. So there's a lot of volatility in these things.
Oh, so I get
this is stressful stuff, man.
Yeah, so the guy, you don't want it to go under the 100. So you're hoping it goes to more because then you make the difference.
Yeah, like if it's a put option, you want it to go down. If it's a call option, you want it to go up.
Okay.
It's really complicated. I don't know if we want to kind of get into
it's just good
details.
That you kind of,
But I think the idea is just basically like the more volatile your portfolio is, the more stress it's going to cause you.
You're looking at it every day.
Well, you have no choice.
2 or 3 days,
and the price swings themselves are going to drive you crazy. And in the meantime, I think that, if you've arrived and you've made it and you've got more than enough, now I think the people I work with, at least usually, now they're starting to look outwards and they're starting to think about how they can help their families and how they can help their communities. And it's more about doing that than it is about just accumulating more money. Well, if that's now our objective, now I think we can focus on really kind of simplifying the management of the portfolio, doing it really simple in a way that you understand, you see all the costs, And, you know, another thing that I talk about a lot is wealthy people get caught up in things like hedge funds and private assets, private equity, private debt is very popular these days.
Exclusive. I only know the stocks.
It's marketed as exclusive. The problem with a lot of these things is if you want to sell it, first of all, you don't know what it's worth on any given day. It gets, you know, it'll get valued 4 times a year if you're lucky.
Yeah.
Maybe only twice or only once a year. It has a professional valuation done. And then on top of that, even if you wanted to sell it, you don't necessarily have someone to sell it to. There's not even necessarily a market there to sell it to. So you might have to sell it at a discount if you really want to get out. You might not be able to get out at all.
So if it doesn't go public, you're really just sitting out with like...
You end up with an asset that you can't sell. And some of these funds, if they have a lot of people wanting to redeem, they have the option to say, okay, we're going to stop redemptions now because we can't sell assets fast enough to meet the redemptions. And that happened with some mortgage funds here in Canada a couple of years ago.
Yeah, there was one not long ago.
I don't want to name specific ones.
I'm not going to name any, but they stopped giving dividends for a bit just because they're very wealthy too.
I mean, one of the biggest ones in Canada, not the biggest one, they cut their distribution a couple of times.
Yes. And
they wouldn't let people get their money out. I look at something like that and I'm like, is that really worth it? Right? Is it really worth it when I can build a portfolio of very liquid blue chip stocks? Your long-term return is going to be, you know, in the high single digits safely. You know, why would I pursue some of this other stuff that has all of these extra risks? It's more expensive. There's more fees involved. You don't really know what's going on. Like, to me, it doesn't make sense. Now, one of the things we didn't talk about, I've seen it because I've been there. I spent 11 years working in a family office. So, meaning that, you know, I saw what was being marketed to the wealthiest investors in Canada. Like, I saw what these guys were, I saw what was being pushed to them. I saw what other families were invested in. You know, generally speaking, there's a lot of complexity. There's a lot of liquidity. There's a lot of costs. And there's not a lot extra in the way of returns. In the time that I worked for the family, it was 11 years, our best performing asset was our public market stock and bond portfolio was our best performing asset.
That's like S&P stuff, like style?
Yeah, like just, well, I mean, we didn't own the index. So I'll talk about that in the book too. And if you want to talk about index, I can talk about that as well.
Yeah.
I generally think that indexing is great for most people. I think that when you get up higher in the wealth scale, you have better options than indexing. People might disagree with me, and that's fine. I think there's a lot of arguments to be made one way or the other, but that's kind of where I've fallen on the argument. But essentially, yeah, your returns are going to be very similar to the S&P over time, but it's just going to be, you know, hopefully a little less volatile than that. And that's a big part of it as well, is if we can reduce volatility in the portfolio, then you're going to more likely to stick with it over time. I tell the people, essentially, you know, my investment style can be boiled down to the idea of the best investment in the world is common equity. It's pieces of equity of a business. And whether it's a private business, something that you built and sold, that's how you made your wealth, or whether it's a public stock that you can trade that equity. Equity in a business is the single best investment that an individual can make. So based on that belief, you can create a portfolio of public equities that so let's not like don't call them stocks, they're businesses.
Yeah.
Right?
They're pieces of businesses.
They're pieces of businesses. If you think of them not as stocks, but as pieces of businesses, I don't care what the stock price did today.
No,
right?
How's the business doing?
How's the business doing?
Yeah.
And management is going to report to me every quarter how the business is doing, and I'm going to focus on that. And when I talk about building a low-risk portfolio, I'm talking about building a portfolio out of companies that are profitable, that have low debt, that are sustaining their margins. I'm going to talk about all that stuff, right? And the stock price is a consequence of that. But if we focus on what's happening inside the company, that's what's more important. And it's easier for people to understand. So if somebody comes to me, they've built their wealth by building and selling a business, they understand the concept of owning shares in a business. Mm-hmm. That's what we do. But what we're trying to do is diversify. We're trying to diversify globally, diversify across different industries. And so that's the idea behind what, you know, you try to do. And if you believe that that's the greatest asset in the world to own, and I do, real estate is probably a close second. Mm-hmm. But I think equity is better because
when it comes to real estate, I think you told me once, the reason why a lot of people do well with real estate, it's because they don't sell them. It's very hard to liquidate real estate. You can't just click a button and sell it. So a lot of people just don't sell it, and that's why they make so much. And then it would be the same thing in stocks. If it was very hard to sell stocks or businesses, they would keep it longer, and then they would make, like, if you kept any of those businesses 25 years ago and you had it today, you're making, let's say,
if you treated your stocks like you treat your real estate, like your buildings, you would make a hell of a lot more money. It's harder to do that because if you had a rental and you had somebody coming to you every day, multiple times a day, offering to buy it from you at a certain price, and that price was swinging wildly. Some days it would be really high, and some days it would be really low. You might be tempted to sell it to them.
Yeah.
Right?
And you're checking on it every day.
And you'd be checking on it. And you'd be wondering, how much am I worth? How much is my building worth? If you treated your stocks like you treated your buildings and said, I don't care what's going on, right? So I want to buy, in the same way you want to buy, Class I office space in a good city, in a growing market. You want to buy the best companies in the industry that are selling into growing markets, that are led by really strong management teams, and buy them and just don't worry about anything and kind of forget that you even own them. It's better than real estate because you're not going to have to negotiate with your tenants. You're not going to have, like, if it's residential real estate, you're not going to have to fix any toilets, or like you're not going to have to deal with any of that stuff. And if one day you decide that you're wrong, it's really easy to sell. You don't have to pay an agent 5%.
Capital. Well, you still have to pay capital gain, but yeah, you don't.
You're going to have to pay your capital gains or get your capital loss, whatever it is. But you can get out. You can get out in a day. There's no cost, right? What your cost is a couple of bucks of commission. So
that's true.
Yeah, like
you got to pay 5% to realtors.
Exactly, and then the lawyers, and then like you're up to almost 10% on some of these deals. Yeah. So I just look at it and say, like, the philosophy is exactly the same, but it's so much harder to do, right?
It's hard to acquire real estate. It's hard to get rid of it. It's hard to acquire. You got to qualify.
Yeah.
And you get rid of it. And you got to check on it more. There's more work. That's what real estate, I think, has. It's a different ball game. Stocks, you don't got to qualify to buy shares or a business. You don't have to. There's a very low minimum.
Exactly. Yeah.
Very low minimum. You can get in with $500, $100.
You can open up a Robinhood account on your phone in about not Robinhood, Wealthsimple or Robinhood or whatever. Yeah. It'll take you about 5 minutes.
You have $100. You can
transfer it in from your bank, and you can start investing.
Yeah.
And you can buy one share. I mean, one share of McDonald's right now. I like the new McDonald's burger. Yeah. Big Arch is excellent, by the way, if you haven't had one.
It's good.
Get yourself a Big Arch. Make sure you're hungry. Yeah. But I mean, say, I love this new burger. I'm going to buy McDonald's stock. You can buy, and you don't need a lot of money to do that. And so that's kind of, I think that buying public stocks, we've been able to do it for so long. Like, people think it's kind of boring. Oh, you just buy. There's all these kind of crazy investment strategies out there, the private markets and the hedge funds and the commodities and all this stuff. And it's like, isn't it cool that you can buy a piece of some of the biggest and best companies in the world, like you or I?
You could buy a piece of whoever makes this.
Yeah.
You could
so just a chump like me, right?
Yeah,
can
Samsung if you want.
Yeah, exactly. Yeah. So you can just kind of. You can own a piece of this company. You can be an owner of this global company. And I think that there's something so amazing about that people, it's been around us for so long, we don't really stop to think about how neat that is and how cool that is. And it's also just happens to be the asset that has generated the most wealth ever. Like, you're never going to make more wealth than you will in the stock market.
It's almost like it's propped up. It's almost like it's like everybody puts their money, because I think the U.S., you can correct me if I'm wrong, but I think in the U.S. their pensions are in stocks, like their
like
IRAs.
CPPs and stocks.
CPPs and stocks too, right?
Yeah, like there's
lots of REITs though. I think 1/3 of pensions are in REITs. No,
they might they might own a lot of real estate directly.
Yeah. Pensions. Yeah, a lot of pensions.
I wouldn't say it was propped up, because that sounds
not propped up. That sounds
like nefarious.
It's hard to fail. I don't mean that way. I mean, like,
look, when you own a stock, when you own a company, you own the labor of everybody who's going to work at that company that day. You own the brains of the management team of that company.
The assets and like furniture and
you own the hard assets. And so, like, from my perspective, like, just use COVID as an example. Companies had to pivot their business plans. They had to adapt to a new reality, and some did really well at it.
Yeah.
And they
like
really
Amazon
boosted their profits.
Stock, because they did really well during the pandemic. Everyone used that.
It was a big winner for Amazon.
Loser for the hotels, I think, got crushed.
Hotels got crushed. But I think, the point I'm trying to make is like, so you might have looked at what was coming with COVID and panicked and sold everything. And if you own the index, you might have sold everything because you saw what was coming. If you had a perfect view of what was going to happen with COVID and how long the shutdowns were going to be in place, like years later in Canada, a year and a half later, we were still having these rolling lockdowns. If you had known that in spring of 2020, you probably would have sold everything and gone to cash, and that would have been a huge mistake because the market was so strong. And part of the reason for that is, yes, the government pumped a lot of money into the system, but also the management teams of a lot of these companies, they adjusted and they adapted. And so whatever's coming down the road, like some people ask me, what's going to happen? Like, what if we have inflation going forward? Or, what if, the US dollar, people were talking about it collapsing not too long ago, and now it's been extremely strong.
Super strong, yeah.
So no one can predict any of this stuff.
The dollar just went down, supposedly.
Well, that's a whole other topic.
Oh, yeah, because of the news.
A lot of it's the strength of the US dollar, too. But I think that people are always asking, what if this and what if that? And when you own pieces of individual companies, part of it's like, I don't care. Like, the management, if I know it's a strong company with a strong business and a management team I believe in, they'll figure it out. That's kind of their job. Is to figure it out. So, that's again part of what you own when you own a piece of a company. And if you think about it as a stock and you get worried because it fell 5% or 10% today, and you let that stress you out, you're forgetting what you really own is a piece of a company that you want to hold on to for decades, not a stock that you're trading.
If someone came and if you have $1 million property and someone knocked on the door and said, "Here's 900," you're not going to sell it. You just go away. But but if you look at your computer every day or whatever, and you're saying, "Oh, someone just offered me 10% less. Oh, I'm getting worried." It should be the same feeling as someone knocking on your door and saying, "I'll buy your property for less," and you just tell them to go away.
If you were reading in the newspaper in the morning about how Canada's going to go into a recession, the Ottawa economy is going to collapse, federal government's laying off 50% of their staff, and let's say you own a rental apartment
downtown.
Okay? So you're reading all of this news in the morning. Everyone is so negative. And then someone knocks on your door and says, "No agents, nothing else. I've got $900,000 in cash in my trunk right now. Sign it over." You might do it. The reality is it's not that simple to sell real estate.
Exactly.
And so that's why people will hold during these periods. But with a stock, it is that simple. And you can do it, you can act impulsively. Like, you can just pull out your phone while you're on the bus on the way to work and put your sell order in, and it's gone. Like, you don't have to.
You could have bought and sold 10 times by the time you got home.
You could do it during a bathroom break. You could do it while you're sitting on the toilet. Right? Like, there's nothing to it.
And somebody will buy it or someone will sell it.
So, and that's the problem is your emotions take over, and because you don't have a plan. You don't have a plan. So I think that, focusing on the long term is a big part of how you get over that. And, the return numbers show that over time, stocks outperform every asset, including real estate. We know a lot of real estate millionaires.
Most people I know personally are real estate millionaires.
Right, but we don't know a lot of stock market millionaires. It's just people who made money somewhere else and then invested in the stock market. But I feel like if we treated stocks the way that we treat real estate, you might know a lot more stock market millionaires.
That's true. Stocks or owning businesses, they say the next boom, the next person, obviously this is not financial advice, if you're looking to invest, you should look for boring businesses that have been around for 20, 30 years. Let's say, I don't know, plumbing or HVAC. And you go buy them all. And then for some reason, you'll make way more money doing that than real estate, example. Because some of these owners have owned HVAC companies for 30 years, but their kids don't want it.
Yeah.
But I think REITs or not hedge fund, maybe fund companies are going around doing that. They're going to a HVAC guy, I'll give you $1 million for your HVAC company. They're doing it to everyone in the city. And that guy's like, "Oh yeah, I'll take it." For sure. He doesn't even think it was worth that. Yeah. But he'll take it because his kids don't want to take it over and he's retiring.
Good example. There's funds out there buying dental practices. There's a lot of that happening. Yeah. Private equity, and there's a public company in Canada that does it. And that's the idea. Right? Is you give exit capital to an entrepreneur who's got a small business.
He wants to retire, and his kids want to take it over.
It creates liquidity for them. So, but the principles are always the same, right? You just want to buy an asset that has cash flow, that has a value. That's always the objective when you're building a portfolio.
And the more you own, you can correct me if I'm wrong, but the more you own, your EBITDA, what's it called?
EBITDA?
EBITDA? So what does that stand
Earnings
for?
before interest, taxes, depreciation, and amortization.
Which gives you the equal of what your business is worth, right? There's like a number, let's say.
So what they'll do is they'll basically take your earnings, they'll take out things like depreciation and interest and tax. So like, what's the earnings power of your business? And then they'll apply what they call a multiple to that.
Yes.
And
so
that's how they come up with a price. It's very simple. It's the inverse of the cap rate in real estate.
Yes.
Right? So it's the same idea. It was like, what's the earnings power of it? And that will dictate how much we pay for it. And that number is going to go up and down too, depending on where interest rates are, what stage of the economic cycle we're in, all sorts of stuff.
So they were, so example, let's say you had one dental practice. It's worth, let's say, 2 EBITDA, or like the equal to 2 times.
Like 2 times?
Two times.
More than that, but okay.
I'm just giving you an example. Let's say 4. Only one company. But if you ended up buying 10 of the same one, it would go up drastically when you own all 10, because you're only paying for one management, you're paying for one marketing team, you're paying for whatever it is. There's a way.
I mean, there's some financial engineering that goes on there.
Yeah, there's a reason why it's worth more, and then you're also eliminating competition by doing that if you do it in the so there's like a whole math to it. So I think that's one of the things, is that the reason why these fund companies or hedge funds or these wealth management companies, I don't know, let's say fund companies are buying them, it's because they're very cheap for what you get in return.
So I'm going to caution you here, and this is kind of part of what I talk about in the book. Yeah. You'll find a lot of funds that are out there saying that they do this kind of stuff.
Okay, so I'm talking about, this is like one of those videos I saw on social media.
You'll find a lot of people go out there and say they're doing it, and they've got like some secret sauce to generate returns doing this kind of stuff. So buying private assets tends to be very illiquid, so that's one thing to keep in mind. And then, I think this whole topic...
Yeah, it's a whole thing.
Is
the whole podcast.
It's also not the topic of the book, and I forgot what I was going to say here, but basically, they...
Caution versus someone telling you off TikTok or social media.
Well, now we're talking about strategies that get marketed to people that say, we can do this for you, and they'll do it, and they'll charge you a lot of money to do it.
So this is like a sale.
And they'll lock you in, and 100x, now I'm saying, well, why don't we just buy McDonald's stock?
Okay, yeah.
Right? like that's kind of what it comes down to is...
same reward.
So a lot of these funds, they're not funds so much as they are actually operating their own businesses. So you're invested in a fund, but if that fund's business is buying a bunch of businesses that are in the same line of business, that's a business. That's not a fund. That's a business.
You're buying a business of that business, buying the other businesses.
Yeah. And so now you're investing in a private business. And so now it's like, with all of the hassle and headache and everything else that comes with that, and you're a minority investor, and you have only, like, I don't know what your voting rate is, 0.5% maybe or whatever, you're going to get dragged along, you're going to have no control over it. Like, it generally a lot of times turns out to be a shitty investment. So,
uncomfortable, you think about it a lot, and yada, yada.
I know people who've gone into like very simple real estate deals, and years later, they want out and they can't get out. They're a 1% owner of this thing, and the guys who are running it, right? And so it's like, I look at stuff like that and I'm like, was it really worth it? Like,
and they got like their friends into it and their family into it. It's very annoying, so they're always talking about it.
Is it really worth it? Yeah. So yeah, like there's a lot of complexity when it comes to that, but I think coming back to the simplicity is really important.
This is like my thing with real estate. I always tell people, try to be the person who's buying it. Or if you're going to buy it with a partner, like, make sure it's like a family member, like your wife or brother or sister, like parents, like someone that you don't mind talking to and splitting profits, and you're not going to get mad if you're the one who has to go change a light bulb, because buy at that age, like if you want to buy it like real estate, like rentals.
There's a lot of complexity in it.
Yeah.
And you're right. There's tax issues with real estate. I own real estate, but I don't own any real estate directly. I own professionally managed real estate through REITs.
Yeah.
Right?
Which is the big thing to buy real estate.
And I can sell them tomorrow, and it won't cost me anything. It'll cost me $6.99 to sell them, right? And so, I think that that's always, from my perspective, the public markets are amazing because you have the opportunity to do things like that.
Yeah, you're not forced. Like, technically, your friend or the person you know who owns 1% of the shares of the real estate can't get out of, and then you own, let's say, 1%, you can sell yours while sitting on a toilet. It doesn't matter.
Yes.
The other guy.
You like that image, but
yeah,
yes.
Exactly. You know what I mean? Sitting on a toilet, reading your book.
Yes.
And then, or if you own it with a friend and he's like on vacation or whoever it is, you don't even know them. Let's say it's like a group of investors. It's hard to offload. But in a REIT, when the REITs are big and they can buy properties almost like cash a lot of times, and they get really good deals because they can pull triggers fast. Because the thing is with real estate, I think Warren Buffett said this. He said the reason why he doesn't buy real estate, even though he's one of the biggest builders, his business is one of the biggest builders, home builders in the U.S. The reason why he doesn't buy real estate is because at a level that he would buy at, he wouldn't get a deal. So it'd be useless for him to buy. Like for someone at my size to buy real estate, I know what deal to look for, and it's sort of, there's a bit more squeeze. But to be honest, it's been hard to want to buy real estate for a lot of people in the last 2 years because the rates are up and the prices are up. So
I think you have to know what you're doing.
Yeah,
and it's a business. It can't be something, in my opinion, it can't be something you do in your spare time necessarily. I think you can do better, buying stocks or hiring a professional to buy stocks for you, and as long as you're not paying them too much. But if you're going to really do well as a real estate investor or as a landlord, there's work involved.
There's work involved. No,
the buying
real estate is a lot of work.
Someone else is going to put the work in, right? Yeah. And so
my cousin is a stock buyer, or he invests in individual stocks.
Yeah.
And once he told me, stocks are better than real estate. I said, well, just different investments. I know you're saying like you can make a lot more money long term if you held it. If I held a real estate triplex and I put $200K to buy it down, and you had $200K in an index fund or like in the safe stocks for 25 years, you're saying that the stocks would do a lot better than that in historically.
So yeah, I'm saying like
25 years. If you held both, if you treated them both,
talk about a specific triplex, but like if you talk about a diversified real estate portfolio versus a diversified stock portfolio, stocks will outperform.
Okay, yeah. And then what I was explaining to him was, for me, it's because I was doing the math. If real estate goes up like a minimal, let's say 5%, and the stock goes up 10%, but to get it, when you go up 5% on a real estate, let's say $1 million property, it went up by 5%. That's $50,000 of increase. I know you don't make it if you sell. You got to pay realtors. You got to pay lawyers. It's not free 50. Yeah. But if the other one goes up by 10%, you only put like 200,000. Let's say 200,000 on that. It went up by 20,000 versus the other one going up by.
So now you're talking about the impact of leverage.
Yeah,
right?
The leverage impact. So in stocks, is there that option?
Well, there is. I recommend against it. Warren Buffett recommends against it. I think if you know what you're doing, you can use leverage to invest in the stock market. I think if you were going to go in that direction, I certainly think that a low risk investment approach makes a lot more sense because it reduces the volatility in your stock portfolio.
And you're better to get leveraged if it's safer stocks or if it's...
Well, I mean, the leverage you're going to get is probably going to be the same no matter what. And I wouldn't recommend buying on margin either. Like, you can open up a margin account at your broker, and essentially your broker will lend you money to buy stocks. Theoretically.
At interest.
Right, at interest. And it'll be a little bit of a higher interest rate. And that loan would be secured by your stock portfolio. If you do want to borrow to invest in the stock market, the way to do it is to borrow against real estate, borrow against your home,
and then buy
get it's the lowest cost that you're going to get. Make sure it's a fixed rate so that you have an idea, because the worst case scenario is interest rates go up. That would be very bad for the stock market, and it would increase your interest costs if you're on a variable mortgage.
So you get hit twice.
So if you're going to borrow to invest in the stock market, invest fixed, borrow against your home, you're going to get the lowest borrowing cost, and buy a portfolio that is lower volatility. Don't borrow and then put your money in Nvidia and Tesla. Borrow and put your money in,
very old dividend funds.
A stock that pays. I mean, dividends are preferable because hopefully they're going to give you some cash flow. So I did this during the pandemic. It was one of those things where there was just this opportunity to borrow at extremely low rates.
Oh yeah, like people are getting 2%, 1.8.
Yeah, like under 2%.
Yeah.
And locking in for 5 years, and using that to buy stocks that had solid balance sheets and were paying 8% dividend yields, 8 and 9% dividend yields.
It's easy.
And I did it.
Switch. Yeah.
And it was scary because it was actually like I thought it might be too easy, because it's never supposed to be easy. If anything is too easy in investing, you're missing something.
Yeah.
And I was kind of like really stressed out because I'm like, this is sitting here like,
what am I missing?
Am I walking into a buzzsaw? But it worked out really well. So I think if you're intelligent about it and you pick your spots, I think you have the opportunity to juice your returns by judiciously using debt.
The banker that I'm talking about, he explained to me to buy stocks too. He's trying to he's telling me about it. And for me, he gave me the advice of buying Canadian dividend fund.
Yeah.
And for me, it worked out. Well,
Yep.
you bought at $80. I think it's like 105 or something. Maybe, I don't know.
Yep.
And it gave dividends. They paid dividends the whole 4 years, And it's funny because I thought he did the same. So I brought up like, hey, we're doing very well. He's like, no, I didn't do that. I give people advice that it's good, but I didn't do it.
So he probably took more risk in his
Yes.
portfolio. It's funny, it works out that way. And I think most professional portfolio managers would say that their own portfolios tend to be riskier than their client portfolios.
Yeah.
Mine are. And the reality of that is that my portfolio performs worse than my client portfolios do.
So you just listen to your own advice.
If I should listen, I'm learning as I get older. I'm learning to listen to my own advice. I think that, and it's really funny because, when you're managing money for somebody else, you feel a real sense of responsibility to them. I know I do. You sit down with people one-on-one at the table and you hear about how hard it was for them to create their wealth. You hear about the uncertainty that they have to face in their life and, what that wealth needs to be there to do for them 10, 20, 30 years from now. You feel a huge sense of responsibility. I can't gamble that money. I can't do it.
It's all preservation there.
Right. It's like this person has given me responsibility. They put their faith in me. And I feel like, the bar is that much higher when I manage their money. When I manage my own portfolio, I'm like, I might buy something because I just read an article on
NVIDIA.
it, and I have not done that.
No, I'm just saying.
But I think I tend to do less work. I tend to take far bigger bets, and generally speaking, it doesn't work out. It's weird. I think most portfolio managers would tell you the exact same thing, that their client portfolios.
Oh yeah, everyone at that office was like blowing up their accounts. They weren't doing very well, but all of us who listen to them, I'm like, oh, great advice. Thank you so much. I thought we were all up. I'm like, they're like, no, like we didn't listen to it. I'm like, wow.
You know how they say like the person who represents themselves in court has an idiot for a lawyer? Well, I think maybe the portfolio manager who manages their own portfolio has an idiot for a portfolio manager. Like I know people who are professionals in this business and they hire somebody else to manage their money for them because they know that, because there's an emotional element to it too, right? So as soon as you start thinking about your money or your portfolio emotionally, you're going to make mistakes. And part of what we do for clients is being that kind of voice of reason between them and their portfolio prevents them from doing stupid things. I work with people who have invested really well on their own throughout their life, and then they'll come to me and be like, okay, you take it over now, right? They've been really good investors and they know their stuff.
You're impressed when they show up because they did it on their own.
They come in, but they realize. They're like, I'm getting older, I don't have as much time for this, I'm not as sharp as I used to be, and, they can feel also the emotions come into play because, maybe now this is money that becomes more important to you. There's not more income coming in. Now you maybe, you have a spouse or kids who, now you're not thinking, there's not abstract numbers on a page. Now it's like, this is, money for my, grandchildren's education or whatever it is, healthcare for a spouse if they have to travel out of the country or whatever it is. And, I think that there's a personal element to it. And as soon as you attach a personal element to money, you're going to get emotional about it and you're going to make mistakes.
That's true.
You lose that cold rationality that you have to have.
Emotions in investing is really bad.
It's
because
very bad.
even makes you, if you get too excited, it's bad. You might do things too early, too fast, whatever it is. And also make you sell quick if you get emotional. There's a lot of issues with it.
You learn to harness them. I think, like from my perspective, I've been investing for a very long time, and I know there's this feeling that you get when the market is collapsing. And, there's
like
kind of
calm before the storm type of thing?
No, I'm talking like in the midst of the collapse.
Oh, okay.
And, you're going to have bad days. You're going to have days the market's down 5, 10%. You're going to have those days and you're going to experience them. But sometimes when they accumulate one after the other, there's this feeling that you get where you feel like you're going to be physically ill. Like I've felt this. Hurt. Like, so I know if I have no appetite, I feel sick, I feel dizzy, I'm like, you know what? It's time to buy. Right? And it's crazy but I recognize that now. Because if I feel sick looking at my portfolio and my clients' portfolios, if I feel sick and stressed out, I know everybody else out there is feeling the exact same thing.
They're all reading the same news you would read.
And what do you do when you feel that way? You want to end the pain. Yeah. So these people this is what you call capitulation. This is what you call like, this is too much, I can't take it anymore, I'm out.
Yeah, you quit. You throw in the towel.
And so they're throwing in the towel. People are doing it themselves. People are calling up their broker saying, sell it, get me out. I've gotten those phone calls in the past. Every financial advisor has gotten those phone calls in the past. They always come at the bottom or within a day or two of it. And I know when you feel that feeling, so I've been able to kind of, you can't ignore the feelings. You're going to feel them.
The gut.
I know what they mean now, though. And I know that I'm not the only one feeling them. So you use those to your advantage.
Yeah, and you're hoping 90% of the people feel it and act on it.
It's horrible. It's horrible.
You're thinking, wait, this is the feeling I feel like selling, I should buy. And
Yes.
wasn't there a saying, I'm going to say Warren Buffett again, he didn't say the best time to buy is when there's blood in the streets?
I don't know if he said the blood in the streets, but he said be greedy when others are fearful and fearful when others are greedy.
Yeah.
So when people are fearful, be greedy, get out there and buy. And that's exactly it. And it's scary. Like I'm thinking about COVID. It wasn't just a stock market crash. It was, everyone was worried about their health and like their relatives who were in nursing homes. And like there was a personal element to it. And, I have clients who are doctors and I had, clients who had relatives who were doctors and they would like forward me emails that they were getting and sending from the hospitals and like the panic.
Yeah.
A doctor in New York basically, told all of his friends and family, sell all your stocks on Monday morning. I'm selling all mine. Like you could see the panic happening. And it was...
There was a dip early in the pandemic.
There was a huge dip.
There was a huge
dip.
dip.
See, you forget it. We
Yeah.
bounced back so quickly. I mean, I can't remember what percentage we were down. We were down 30 or 40%, like in a snap. Because, I mean, everyone was just completely frightened. And I felt that feeling. And I remember that morning sitting at my desk, feeling that feeling and knowing, all right, it's time to open up some spreadsheets and time to do some buying.
Yeah. That's good. That's true. I remember that dip, and that scared a lot of people. A lot of people weren't buying at that time. Like you couldn't sell anything at that time. There was like no buying in real estate as well. I remember like taking off my clothes before going in the house. Like,
Yeah.
Like I remember it was weird times.
They're wiping down our groceries.
Yeah, wiping down your groceries. It was weird. It was very weird times. People forget it. Let's say this. Let's say you had to tell a young person who just wanted, like you were 18 when you started investing. Let's say you had to tell an 18-year-old to invest. What would you tell an 18-year-old today? Like how? Like what the local like?
So
what advice would you give an 18-year-old?
We've got a really interesting environment today, and the economy is really. It's tough for young people. I feel really bad for young people today.
Really? Like I know in real estate we feel bad for young people today. So how do you feel bad for?
Well, that's why. I think it's so hard to start a life. It's so hard to get your foot on the ladder, right? The number one thing everyone at the end of the day, the cornerstone of your family's wealth is going to be probably owning a home and owning it debt free. And so, someone who's I don't know, in their mid-20s, let's say, starting out, it's so hard for them to save money to get to a down payment. So you get to the point where it's like, okay, it's kind of hopeless. Like maybe I can save 20 grand in the next couple of years, maybe.
It's not even.
And then,
5%.
maybe, so it doesn't even get me part of the way there. So what do? So now they figure, well, I might as well, the difference between 20 and 0 is basically nothing to me, right? Like it doesn't matter. I'm so far away from that down payment, it doesn't matter. So they'll take that 20 and they'll go crazy with it. They'll make the big bets. That's why Wall Street Bets on Reddit is so popular and people are buying Bitcoin.
Oh, that's still a thing. Wall Street Bets is still a.
It's still a thing.
Active. Okay.
They're still out there buying like GameStop and all these stocks. They still are, and crypto is a thing. Like fart coin is a thing.
That's a real thing.
That's a real thing.
People are buying it with real money.
People are buying. Yeah, it's like hitting new highs.
American dollars,
So
yeah.
there's this gambling mentality that has infiltrated financial markets, and I think that's because young people basically are like, what's the point, right? Like I might as well gamble it. If I've got 20 or I've got 0, I basically got 0. So I might as well try to turn that 20 into 200 or 400 or whatever.
Yeah, but isn't there a safer way to do that? Like to turn it to 100?
So there is. And here's what I'll say to a young person today is your biggest component of your net worth isn't your assets. The biggest component of your net worth is your
labor.
future earnings power. Okay?
Yeah.
And your future earnings power is basically limitless.
Yeah.
Right? Your best investment when you're young is to invest in yourself, invest in your skills, invest in your health. Make sure that when you're an old guy like me, that you're still
be in
able
good shape,
to keep
yeah.
doing it, right? So make these investments in yourself,
Yeah.
and all of this is eventually going to pay off. Now, on the investment side, And it's funny because I wrote this book kind of directed towards the wealthy person who's kind of made it. I told a story in the book about when I was in my 20s and I was investing in internet stocks, and I made a lot of money, and then I lost a lot of money. But I remember
went up and then back.
Yeah. And I remember talking to a friend of mine, and he didn't touch any of these stocks, and he just bought banks. He just bought Canadian banks.
And he's retired probably.
Well, I mean, I remember having this discussion with him, and I'm like, why would you buy, like, it's so boring.
He bought, like, the Canadian TD Bank, RBC.
Yeah, and he's just like, oh, they raise their didividend every year. They're fantastic. And he's a young guy like me, and I'm like, what are you, like, a widow? Like, what, like, we call them widow and orphan stocks. Like, those aren't for like, us.
Widow, orphan.
Those are for like old retired people. And I actually have an illustration in the book that
Did he
shows,
work at a bank though?
No.
Oh, he just okay.
I have an illustration in the book, and I went back to kind of revisionist history. But I said if you bought Cisco, which was like the #1 bubble stock back then, it was a huge winner.
The tech company?
The tech company,
Okay,
Cisco,
yeah.
not the food company.
Yeah, there's a few. Yeah.
So if you bought that before the bubble started, so early 90s, and you bought TD Bank, like Cisco obviously outperformed it for the first 5, 6, 7, 8 years, but then over time, TD outperformed.
Because TD owns some of it.
And if you consider dividends, TD blew Cisco out of the water. And so the crazy thing about this is that...
Oh, really? So out of the 10, 20 years that it existed, Cisco, let's say, if you had bought the TD stock versus the other one...
It completely destroyed it. And so
Oh,
I
wow.
think back to this discussion I had with my friend when we were younger, and I made a lot of money in tech stocks, but then I gave a lot of it back. And he didn't ever worry about any of that. He just like slow and steady, right? And he won the race at the end of the day. And I think that the advice I would have to young people is that right now there's a lot of froth and speculation in the markets. This promise of getting rich quick, you might hit the lottery, you probably won't, or you might have a big win and then give it back. Because you
get addicted to it.
Sometimes the worst thing you can do is have an investment work out for you.
You want to get your hand burned on the stove, like you
right,
say, yeah.
like I did. Because if you make a lot of money in fart coin, you're going to learn that's the way to make money.
You look for all the fart coins.
You're going to look for the next fart coin, and you're going to get killed. So I think that, my advice to a young person is certainly don't worry about the number on the investment statement. Invest in yourself. And when you're investing your surplus funds, do it conservatively. Take your time. We talked about using leverage. I think there's times for certain people, especially if you've got a reliable income, you can judiciously use some leverage. Maybe to, there's some tax planning involved in that too. Maybe you can make your mortgage interest tax deductible. Like there's ways to potentially use leverage. If you're young and you've got a stable and secure job, why not? You have an option maybe to add to your returns that way. So I think investing
in yourself, knowledge, like, and if you do invest, know what you're investing in. Make sure you understand whatever
100%.
it is, because that's the problem now. I see people investing in stuff. I'm like, do you know what it is? Like, I don't know. My friend's doing it, and you're like, okay.
You'd be shocked the extent to which that happens, and the extent to which that happens with some of the wealthiest people out there that just follow other people into investments. And a lot of times as it's marketed to you... I thought it was just
kids doing that.
No. Sometimes as it's marketed to you, like the person will come to your office with the fancy pitch book and everything else, and they'll be like, well, you might know some of the other names in this, and they'll drop some names on the side. And it's like, okay, well, I know that they're in it, but I don't know. It could be 0.01% of their net worth.
Yeah, you might have given it to them or something. I don't know.
I just think that this applies for everyone. Understand what you're invested in. If you don't understand what you're invested in, when things go bad, and they will, we're going to have recessions, we're going to have drops in the market, we're going to have...
There's cycles, yeah.
We're going to go through that. If you don't understand what you're invested in and believe in it, you're going to sell. And I have a friend who's been talking to me about Bitcoin for the longest time, and I get it.
Like long time, like 10 years long time, or like a year long time?
Several years.
Yeah.
Several years. And I knew the story from very early on. I remember attending a session very early and learning about the blockchain and learning how everything worked. And, to my eternal regret, not buying it back then. But the reason I didn't buy it, and even if I did buy it, I would have sold it the first time it dipped. Because what I don't have in it, I get it. I get the story. I understand the libertarian aspect of it, and I understand that central banks are devaluing our currencies. I get all that stuff.
Yeah.
But I still am not convinced that the long-term solution to that is this thing called Bitcoin. And so when it collapsed, I would sell. And so I know that. I know that ahead of time.
You would have sold very early on.
I would have sold very early. And I know that ahead of time. So I know even if I bought it today, that the next time it collapsed, I would sell because I don't believe that enough in the story. And so I talk about conviction in the book. You have to have conviction in what you own. You have to understand what you own and why you own it. And if you don't, you're going to crack. And sometimes that means you're walking away from stuff that makes a lot of money. You don't have to invest in everything that goes up. I think a lot of people feel like, greed takes over, especially you see like your neighbors getting rich and you see your friends getting rich.
Oh yeah. Everyone's got new cars.
You want to be part of that. Mm-hmm. And so you jump on, and the problem with that is, that's the sign of something that's getting very mature, is more and more people jumping on it.
Yeah, when everyone's talking about it, it's not a good time. And that's what happens in crypto.
I say there's the fear of missing out, right? Everyone has FOMO, and I say you should have the joy of missing out. Like that should be part of your investment identity. I'm not going to take part in the mania.
Yeah.
And even if you're in it early, like there's, I've had things where I bought it early and it turned into something that was very popular. That's awesome. Yeah. But you have to consider, okay, that means you got to get out. You don't want to ride it down.
I bought a stock in the pandemic as my first one. I bought two. One, I bought $1,000 worth. This is funny. They're gonna hate me for this. I bought $1,000 worth of a stock, and it went to like $1,200. And I sold it. I thought it was great.
Okay.
And then I bought another one, $4,000, because I'm like, at $1,200, I'm gonna try $4,000. And there was a guy on YouTube saying to buy it, and it was gonna do whatever, and I bought it, and it went from $4,000 to like $40,000.
4 to 40.
Yeah, it was called MindMed. I sold the first $4,000. I just took my money back out.
Yeah.
And I emailed the guy. I'm like, hey, I bought the stock because you said it. Like, he's like, oh wow, good. It's like whatever. It's called a unicorn, I guess, at the time. And I tell people the story like F you, Danny, like as if this happens to you, And then it went back down to like 7,000.
So there you go.
So I got my 4, and then the rest went down to like 7,000.
Yeah.
But it was that was my second stock ever purchased. And then didn't buy any more. I bought also, so my buddy would tell me that he's buying, there's like stocks that you buy that before they go public. So let's say they're called $10 shares or something. I forgot what they're called. SPACs. So SPAC was a big thing.
Yes.
And then I did the same thing with SPAC. If it was like $8 or $10, and then it would go public, it would go up to like $2 or $4, I would just sell it.
Yeah.
This is bad advice. This is not financial advice. I don't know
not
if this exists.
Financial advice.
It's not financial advice.
I'm going to kick Danny's ass after this.
It was gambling.
Yes.
It was gambling. It was fun.
Yeah.
The casinos were closed. I was bored. And I made money. Like, I made some money.
So this is the gambling mentality.
Yeah.
And people could succeed, but I want you to think of that.
But I wasn't doing like I'm gonna like not eat. I was doing like $1,000.
But you're aware of what you were doing.
Yeah, I wasn't like blowing. Like my investments are mostly in real estate and private lending, and then I do mutual funds. Like super safe. Most of my investments is in those.
It's
items.
like putting $100 on the Chiefs. Like whatever.
That's
it's
what
like
I did. Yeah.
So. Look,
but SPACs, sometimes they went from $10 to $20, and the guys at the bank, I would tell them, I did this. They were mind boggling because I would sell half always. I would get at least my money back.
Sometimes they went from 10 to 2. There was a lot of them.
Tattoo chef, and there was another burger place, a hamburger place.
Okay.
They're real restaurants.
Yeah.
So one of them got like a contract with Costco to be in there. So I thought, I read some, and I thought of the food industry thing. I'm like, there's one of them was called like a burger place called Fly Burger or something. It was like Burger Priest or Burger. It's like one of those burger works. It's like the works.
Okay.
Is in the U.S.
Yeah.
And it went from like 10 to, and I would just make sure I sold the money, the $1,000 I put in, and I'd leave it, and all of it went to nothing. So I took my 1,000. Let's say I put 1,000, and I took my $1,000 back, and then the rest will go to zero. Some of them bankrupt.
Here's what I'll say to you.
Yeah.
Okay. So
I sold. Yeah, I was gambling. Yeah,
you knew what you were doing.
Yeah. Yes. I knew it was gambling.
You knew what you were doing, and I think that's
like me going to the casino on my phone.
So here's the stock market.
Not financial advice. I might edit this part out, but
you should.
I should. Yeah.
The stock market was made for the stock market because actually this is a good point because the stock market it facilitates things like that. It facilitates gambling. And trading
is bad
every single day. Trading multiple times.
And I looked at it way too often. That's the worst part. That's why I stopped.
So the people who, if you open up a brokerage account, they make money when you trade. All of the brokers make money when you trade. The whole financial media is driven around the idea that they want you to trade. So even the brokers who are advertising in the Globe and Mail, Financial Post.
Kevin O'Leary was like advertising it, that he's like buying into it.
Well, he's also selling funds, or he used to be. I don't know if he still is. But anyway, point being is like the whole industry wants you to trade. The market is set up for that. You can sit and trade all day long, and there's people who do. What I'm saying
day traders,
yeah. What I'm saying though is just because the market's set up for that, it doesn't mean you have to use it that way. In fact, what you should do is use it to, you access it a couple of times a year. You find a company that you like, that you've done research on, you buy a piece of it, you take advantage of that. That liquidity is there for you every minute that the market is open all year long.
Yeah.
I'm going to use that liquidity for like 1 second to buy the shares of stock that I need, and then that's it. Hopefully, if I made the right decision, I will never sell that company, right? And that's the way we think about it, is like, you're just buying businesses, and let the traders, the market's there to serve the traders, the market's there to kind of serve the ADHD guys and all that stuff.
The gamblers.
And the problem is that I think that gives investing a bad name, because a lot of people I talk to...
Yeah, because this is not financial advice, what I'm saying.
This is not financial advice.
Yeah.
But if you've built wealth in a business or in real estate or whatever, the daily volatility of the stock market scares you, and you do think that it's gambling. Like, I've talked to people, especially like older ethnic guys, right?
Yeah.
Like, let's say they've made all their money in a diner or real estate or whatever.
Most people I know own the real estate that their diners in.
You talk to them and you tell them that you invest in stocks, and they're like, it's a casino, you're gambling. And I think they think that because they see the price volatility. And I think there is an education process that has to take place where you say, yes, there is price volatility, but you can choose to ignore it. You don't have to play that game.
Don't look at it.
There's different games that people are playing in the market. The short-term traders are playing a certain game.
Yeah.
If you're a long-term investor, you don't need to play that game. So if you want to buy, and I've mentioned McDonald's, let's use another one.
Whatever.
Okay, let's say Coke. Let's say you want to buy Coke stock, not investment advice. It's an expensive stock.
Yeah.
Let's say you want to buy Coke shares. It's there on the public market for you to buy. But the way that you should think about it is, you've bought a piece of Coke, treat it like it is a private company. I've bought a piece of Coke and I'm going to own this company. I bought it because I've done the work. I'm going to make money. And 20 years from now, when they're selling twice as much Coke around the world, or whatever it is they're selling, water, whatever, energy drink, whatever, I'm going to make their profits are going to double in 20 years. And so I'm thinking of it, even though I've bought it on public markets, I'm thinking of it like owning a piece of a private company. And if you can do that, now you've overcome one of the big factors that makes people fail in public markets, is that they get freaked out by price moves, they trade in and out, everything else. If you buy a high quality company, I'll tell you one last story. I told this in the book.
Pull the book out.
I told the story in the book about a woman who was not my client, but a client of another advisor who I knew. And she never made a lot of money. I think she was like an administrative assistant or something. She was a depression baby. She never made more than like 30 grand a year. And she was a client of this portfolio manager with a multi-million-dollar portfolio.
Did she work for a company that gave her shares?
No.
Okay.
She had a very specific way to invest.
Okay.
Some would say oversimplified. But essentially, her strategy was she bought shares of companies she knew that paid dividends.
So she knows, like, Nestle. She has Nestle at home. She bought Nestle.
Right.
Whatever.
If it paid dividends, had to pay dividends, she bought shares of the company. If they ever cut their dividends, she sold it. Everything else, she held. And this is back in the day, like, the dividends got sent to you in the mail. Like,
okay. So if she didn't get a check in the mail, she'd be like, "This is weird," and she'd sell it.
She would see the check was lower. She would see the amount on the check was lower. Like, she knew. Like, it wasn't. Keep in mind,
she's an administrator, so
there was no internet back then. The only way you knew what your stocks did is to look them up in the newspaper the next day. That's how you knew what they did that day. Is you would see their performance in the newspaper the next day. So you didn't even know what they did, like, on the spot. Yeah, and then you'd have to call up your broker and say, sell shares of whatever, and they would charge you $300 to sell your shares.
No way.
Yes. So that's how it worked back then.
And so it took so it was harder to sell. And then they would sell and it wouldn't get sold till like the next day after.
Right.
Because they have to put up on the market.
So this woman built this whole portfolio. And basically her sell discipline was, if they cut their dividend, there must be something wrong with it. Sold. Otherwise she held. And she just held. And she held forever. And she ended up with a multi-million-dollar portfolio. And I think that there's this
Would she buy more shares?
She might have, yeah. There's the simplicity in what she was doing. And it didn't hurt that she didn't have kids. I think that helped her save money too. Yeah. But, I mean, there's a simplicity in what she did. And I remember reading an academic paper years later, and I looked for it, and I couldn't find it because I wanted it for the book. Essentially, the academic paper was a study that showed that companies that cut their dividends subsequently underperformed the market. So, this
there was like a reason for it.
Well, this very simple strategy from this woman who had no financial education and no sophistication was actually validated by this academic work. I think that, there's a way to make money in the stock market, and that's an example of it. there's a reliable way to make money in the stock market.
I remember meeting a woman that retired early, probably like in her 40s or 50s. She worked for Air Canada. She was a stewardess, so not not like a huge income. And I guess they were given Air Canada stocks, and she bought a townhome near the airport in Toronto. That's all she did, and then she ended up retiring after like 20 years, and she moved to, I think, Kingston or Belleville or something with like $2 million net worth with her like stock and the townhome. And all she did was just keep buying the Air Canada stocks. And I guess, does Air Canada give dividends? I'm not even sure, but I guess they did so well in 25 years.
Yeah. Well,
this is a 10-year-old story. No, this is a 15-year-old story. But she retired back then. So.
Yeah, I was just visiting a friend in North Carolina and Winston-Salem, and we talked about the R.J. Reynolds legacy in that town, and they made a lot of normal people into millionaires because they paid their employees in stock.
Yeah,
and they didn't sell it; they just accumulated it, and they got their dividends. And when they were eventually bought out by private equity, these people became millionaires overnight. So it's pretty wild.
It's pretty wild.
It's pretty wild. I mean, that's a different story because there's an element of
ownership,
of lack of diversification there, right? Like if you've got everything in one company.
That's dangerous. Yes,
that's dangerous.
But that's how you Corral story
so,
or like Nortel.
Well, that's how you create wealth using concentration, right? But you protect wealth by diversifying it. And so, my approach is really about how do you protect when you've got enough. Because there's a lot of risk.
With us always say like it's all about preservation, wealth preservation.
Yeah, so you've got to, and so in that case, what you have to do is you have to like diversify your bets because you don't know what's going to happen. Like there's
when they invest with us, they take really lower risk. Not really like much lower, but they don't go past a certain loan to value on their loans. Like when they lend money, and they don't like to go in second mortgage. They like to be first mortgage. There's like certain math. They'll do really big ones as long as it's safer. Like they really care about they're safer. They don't.
But
care
they're also not putting 100% of their wealth into it, right?
No,
and so
no,
that's the idea.
To like 10%.
And that's what I'm talking about here. Is like if you were to like bet it all on one stock or on one investment
or anything in the world.
That's a bad idea. Yeah. But I think a lot of these people, like when they've made the big wealth, they've got their employer stock, whatever. That's how they do it. They do it by this concentration in this one asset, and that's fine. I mean, there's nothing wrong with it. If you own the right asset, you can do really well. But you have to remember that there does come a time when you need to diversify that risk. You only need to get rich once.
Yeah,
and I can sit here and I have a lot of stories of people who were very wealthy and had more than enough and then lost significant amounts of money taking further bets that they didn't have to take. And that's kind of the tragedy of it, is it didn't have to happen.
You meet a lot of people who had a really good business and sold it and then ended up buying come to see you after. Like because I noticed a lot of people work really hard their whole lives. Either they own real estate or they had their business. And that's a lot of the reason why they have wealth. And they come to you to diversify, so they keep it for preserving.
Yeah, that's why I see a lot of people who've sold businesses, and that's the idea, right? Is this now? A lot of people have that fire in them that they don't want to stop working. I was just talking to someone today, and he's been in multiple businesses, and he took some time off, and he just said, I was miserable. He couldn't wait, and he just started a new business, and he's so excited. He loves having something to do. I say to those people, like, the world needs people like that. The world needs more people like that. Do it, but also, hey, let's carve out a good chunk of what you've got, and let's diversify it, and let's make sure that your family's well taken care of. Let's make sure that we can set up trusts. We can do all sorts of things to provide for your family, provide for charities you want to give to, and then the rest, go crazy. If you know that this is going to be well taken care of, you have more than you need, now you can afford to take the risk. And now it's not going to be like, you're not risking at all.
No.
So I think it kind of frees you to be a little bit more aggressive almost, because you've got a plan. You're taken care of no matter what happens.
I think you're really right about what you said earlier about it's good for people to get burned a little bit in the beginning, because I know guys who made a lot of money during the pandemic with whatever, stocks or not businesses, but real estate, because real estate boomed too.
Yeah.
Like there's things that I own that nobody wanted to buy for 3-4 months. Now they're not worth the price I'd buy them today. Example. But like at the time, I know guys who sold decided instead of doing, like if those guys would have sold and made, let's say $1 million net after taxes and after capital gain, and if they would have came to you and said, you or a wealth manager, like someone reputable, and they would have said like, I just made this. I don't want to lose it. Whatever. Okay. What they did instead of buying more real estate, or because real estate, you can say real estate is a close second place to index. So I know you don't like. I know you're saying I don't. It's not that you don't like real estate. You said you own real estate.
Real estate's a great asset, but it's a lot of work to own directly.
If you own it directly, it's a lot of work. It's not for people who just think they can sit at home and do nothing, right? So it's not as passive as owning real estate, a REIT-wise or businesses. I'm going to call them businesses. And when I say business, I mean stocks. So if this person would have came to someone like you and say, I have $1 million, what he wanted to do is he wanted to buy another business, which is a restaurant. High risk. Yeah. We all know that. So instead of him coming to see someone like you and saying, I want to open up a restaurant, and you could be, okay, your restaurant is this much. Why don't we carve out this much and do this and take a loan on the restaurant and whatever it is. You can leverage, right? He lost the restaurant because the restaurant didn't do well, and people forget how much work it is in restaurants. You can do 12-hour days for 365 days a year, and it might still fail because the pandemic wasn't a great time for restaurants.
It was the worst
time for restaurant or barbershops or hair salons. So like he lost all the money he made in that one restaurant, that one bet, that one business. If he'd have bought at that time, what's funny, if you could have bought, forget McDonald's, let's call it another restaurant, Burger King, okay? If he would have put it all in Burger King, he'd still have it, and I don't know if they pay, I don't know if it's Burger King's stock.
I think that's the whole idea behind why I wrote this, is because
it'd have been safer for him, I feel,
this is really written for the post-exit entrepreneur. That's kind of the target, but anyone can benefit from it. But it's because of situations like that, and I've seen them happen on a much larger scale. Like we're not talking 1 million, we're talking tens of millions, we're talking hundreds of millions. I think that a lot of people. So here's the thing about
hundreds of millions, and they didn't take this. Like I'm not saying they didn't know.
So here's the thing about
you should at least do half.
Well, I mean, if it was hundreds of millions, let's just say they didn't start, but money was lost, and the idea being that you've created this wealth taking risk, and you don't even realize. And this occurred to me actually. I was working for the family and
family office.
The family office. Yeah. They were all very entrepreneurial, and I started to realize as I was talking to them about finance theory and talking to them about value investing, kind of a light bulb went off in my head that entrepreneurs and investors think about risk in completely different ways. So you mentioned the pandemic, and I tell a story of a friend of mine who had a business that closed multiple times during the pandemic. It was a non-essential. It was people in close proximity. It was like it could not be open when they closed everything down.
Or salon.
And I remember, they closed them and they reopened, and then they closed them again, and then they reopened, and they closed them again.
To get a haircut was like you going like bootlegging. It was like you're Al Capone.
I remember we asked him, I think the last time they reopened, what happens if they ask you to close again? Because financially,
it was like the last.
They're at the end of the line, and he honestly looked at me and he's like, "Don't ask me that question. I'm not even going there." And he was angry that I even asked the question. If you're an entrepreneur, you can't spend all of your time dwelling on everything that can go wrong in your life, like in your business. You can't. You'll drive yourself crazy, right? You can only deal. There's going to be something going wrong at any given time.
5-10 tasks.
You have to deal with what's going wrong in front of you now. If you're worried about what might happen to you like next month, or you're going to drive yourself crazy. Yeah. So I think that there's the attitude of the entrepreneur about risk is we're going to face it head on. We have no choice. They live in this environment of uncertainty and risk. Anything can take them out at the knees tomorrow, and it can come from anywhere.
Rates.
Now, when you're a portfolio manager, when you're trained as a financial analyst, you think about risk in a completely different way. When I'm looking at a potential investment, our only job is to think about all of the things that can go wrong. That's our job. So I'm sitting there in this
literally
meeting,
writing down, this can go wrong, this can go wrong.
Yeah, we're doing all sorts of pre-mortems. Like, what is it? Where can we be wrong on this investment? Like, it's one thing to say, that's a really high-quality company. We're going to buy the shares. That's a simple-minded way to think about it. Every company is going to face all sorts of challenges. And so we have to look at a company, and part of the process of researching it is saying, where can we be wrong on this? Where could management be challenged? Where could the business model be challenged? And what's the likelihood of those things happening? Literally, we spend 90% of our time trying to figure out all of the things that can go wrong. So put the financial analyst.
That's a hard thing to do.
Put the financial analyst and the entrepreneur together.
We'd never do that.
And you realize we are thinking completely different things about risk. And so that's why I wrote this book and called it Low Risk Rules, because I came to this realization.
We're like, we can think of the one thing and go, right, let's try it. We got 1% chance. Let's go. Let's go for it.
And so this is the thing, is like we're not speaking the same language, and I think there's a lot of miscommunication because of that. So the entrepreneur sells their business, and they want to continue to invest the way they've always invested, right? Let's go, risk on, right? And they continue. They're investing for growth. They invest in venture. They invest in startups. They keep doing this stuff. And like I said, I think it's great. A lot of times they contribute. They sit on boards. They do stuff. Like they can really help out a business that they're investing in. But also, hold on a second. Put on the brakes. All right. You got maybe like a spouse and kids at home. Maybe you've got this charity that you want to start, or this, trust fund, or whatever it is. It's like, let's put on the brakes. Let's make sure that all of this stuff is taken care of first. Let's create a plan for you and your family.
Oh.
Now, here's what's left over. Go crazy. But I think that it's that wiring that's where we can work really well together if we can understand and respect each other, right? A lot of times what happens is I got told, they used to laugh at me because every time they put an investment opportunity in front of me, I'd say no. So that if I ever liked anything, it was like they were going to throw a party, because they're like, well, Geoff says no to everything. This must be really good because he actually likes it.
You're like a poker player, like he's got aces.
Yeah, you fold every hand.
You fold every hand versus Geoff. He's got aces.
And that's why it's like, and that's kind of the investment philosophy as well, right? Is like there's an unlimited amount of strikes. In investing, it's not like 3 strikes you're out. You can wait for the perfect pitch in investing, right? You can wait forever, and so you can say no to a million things. If you've been successful and you've got a lot of cash and you've got a lot of like dry powder to invest, take your time. Why rush into the first thing that you see or something someone is selling you? So. Having worked for the wealthy family, I see what gets pitched to them. I see what the multifamily offices are pitching. I see what the big banks are pitching, and all of these firms that say that they're working with. And I'm talking like across North America. Like I mentioned in the book, like I had some really cool investment opportunities put in front of me. Like at one point, I was corresponding by email with a manager of like a rock band that I love, because they were putting together a partnership to fund their next record. I was like, holy shit, this is really cool.
Oh, you love this rock band.
I love them. Like I wanted to participate in this investment so bad, but it was a bad investment. We didn't. Like I recommended against it, but it was really cool. We had an NBA team. We have an opportunity to invest as limited partners in an NBA team.
That's so cool.
Like we had all of these opportunities, and this is what's put in front of these people. But when you start looking at the deals and the terms of the deals, you're like, this is not a good deal. This is not a good investment. And so I think that if you're
the only good part about it is you're part of that team, but there's no money coming back. As a money earner,
a lot of these investments, it's not about return on investment. It's about being part of this group that's investing in it. It's about going to this shareholders meeting that's in Barbados every year or whatever, right? It's like there's this element of, I want to be part of that group, so I'm going to invest in this fund or I'm going to do that. And that's fine, but then it's not an investment, right? Now it's like, now you're doing something else.
You're part of the club.
It's an activity. Yeah. It's a hobby, whatever. Yeah. But if you really, truly want to invest and maximize your returns, these investments don't make sense. Now, I saw them being pitched. I saw other families go into them. And it's funny because, and I tell the story in here about a guy who ran a family office who I met at a conference. And he said, it used to be really easy to, find outperforming hedge funds in the 70s. He's like, now it's impossible now. There's too much competition out there. He goes, just buy an index fund and go home. And I said, well, why don't you just do that? And he laughs and he's like, if I did that, I wouldn't be at this conference right now. Like we were like in Miami at this gorgeous hotel.
Sipping drinks.
And it's like they've created this whole environment around, they've created this whole industry that the clients, feel, it makes them feel good. It makes them feel special. It makes them feel.
It's true. I think if you bought part of the Sens, now you get like special
tickets,
seats. Yeah, there's like a whole thing, but it's not the best like financials.
I think the people who are involved know it's not a great. Yeah. No, it's not a great investment.
But it's part of you're part of the club.
But you're part of the club. And I found going to a lot of these conferences and meeting a lot of these families that a lot of them invested as part of these club deals. I had one family who I knew well, and the son was a CFA. And so he came at it with a very kind of analytical approach.
The son. For the family office.
And the father had made the money, and the son comes in as the investment professional, and he's like, I'm just trying to undo all the stuff my dad did. Like, he did all these private deals, he did all these funds we can't get out of. He's like, I just want to buy public market equities. I can manage that myself, and we can do really well. We are in all of this garbage. It takes so much time. It takes so much effort. And so I feel like
financially it's not good, but like for the dad just did it to be part of the club.
He did it, but also he didn't know. Also he thought that's what you're supposed to do, right? So he made money. He built a business. He sold it to a public company. He had a lot of money, and he was under the assumption that, okay, well, we're going to keep investing the way we made money. We're going to invest in more private companies. We're going to invest in more technology startups. We're going to do this. And so that's what he did, because he thought that's what you did. He didn't know that you could just buy Coke and McDonald's and go golfing. He didn't know that. Like, it wasn't part of a strategy anyone talked to him about. They don't market it because they can't make money doing it. Right?
Oh, yeah, because those clubs have fees and a manager for the club.
Well, we're calling it a club. We're calling it a fund or a multifamily office or a fund of funds or whatever it is. I have a chart in the book that shows all the layers. They create
fund to fund. So you invest in a fund and invest in many other funds.
Yeah. So they create a structure where there's all these layers of people, and they're all getting paid.
You get a black card.
Let's go back to the sports betting analogy, right? Like, so when you bet, they always take a vig. They take the juice. Right?
Yeah, there's always a piece.
So they take a little piece of the bet.
Like a 2% or 1%.
It's just enough to make sure that they're not dissuading you from placing the bet. But, with everyone betting, that's how they make their money.
Yeah, it's dollars. So it's a few dollars.
The whole investment industry is built on that concept. So in the book, I call it the juice, because I like the juice. Because how much juice are they trying to squeeze out of your portfolio is what I say. And so fees are a thing. Fees are a big thing. And when you're dealing with a lot of these entities and these fancy funds and all of these like exclusive funds that they can get rich people into, it's really this elaborate scheme to create all these layers between you and your money. And every person in that layer is getting paid. Right?
So the fund sends tickets to the family office for flights and hotels every year.
No, I'm not saying that.
No, so the fund doesn't do that. It's just
no. They're paying their salespeople. They're paying their salespeople. They're paying their wholesalers.
No, I know that, but like for me to want to invest, like let's say I invest in this basketball.
Well, no, you're not gonna. You don't need them to send you tickets. You can afford to go yourself.
No, yeah, okay.
But we're gonna have an annual meeting, and you can come to this annual meeting. And we're gonna have some like famous speaker, and you're gonna meet like some famous investor
or whatever, like someone funner, I guess, like Wolf Wall Street guy or something.
Let's go back to kind of first principle. So you run an investment firm. You want to create the most profitable investment firm that you can. So what are your objectives? You want your fees to be as high as possible. You want your costs to be as low as possible, and you want to make it really hard for people to pull their money out. So what do? So we're going to create something we're going to call it ultra high net worth boutique, right? And we're going to sell some really like this stuff is really exclusive. These funds are really exclusive. So they have high fees. It's specialized knowledge, right? Like not anyone can manage this stuff. So the fees are going to be a little bit higher on it.
I got special computers.
Right.
I guess.
And also like the strategies, there might be a liquid. So, you have to commit to being in this fund.
Sounds so dishonest right out of the gate.
You have to commit to being in this fund for like 7 to 10 years or whatever. So now you've got them locked in.
7 to 10 years, wow.
Oh yeah, for some of them it's even longer. And so you've created this and because I'm using the external funds, they're the ones who are employing all the analysts and doing all the work and going to make the investments. My guys are just allocating to these funds. There's not a lot of costs involved in that. I'm the middleman. I'm sending your money out somewhere else. So you create this business that's kind of the perfect business. Your costs are as low as possible. Your fees are as high as you can possibly justify. And your costs are very low. And you've got this money locked in. So I think that if you look at it that way, you realize that people, and in particular wealthy people, it's bad enough that, in Canada especially, mutual fund fees are very high. I think that it's unfair.
Mutual fund fees are pretty high.
I think the small investor is paying too much in Canada generally, unless they're... But, it's crazy. Even the very large investor is paying too much. And to me, that's even worse, because now you're talking orders of magnitude of money more every year.
Yeah, 2% on $10 million versus 2% on 100,000 is a big difference.
That adds up, right? Yeah. And do it every year.
Okay, stocks. I know what he's going to say, but stocks or real estate?
Stocks.
Okay. Work from home or office?
Office, always office.
Morning person or night owl?
Morning.
Favorite financial movie or show?
Trading places.
That's good. If you could trade places with any financial icon for a day, who would it be?
Financial icon. I want to be the finance minister of Canada, and I want to cut taxes and spending by 50%.
There you go. That's gonna go well now. That's a big topic right now, and they probably need you. They gotta pick you up on that offer.
Yeah.
You might get a private message.
Pierre, call me.
Yeah, exactly. Pierre. Yeah. Okay, if you had to explain wealth management to a child, how would you do it?
You've worked hard all your life. Now you have to preserve and continue to grow what you've worked for.
What's one piece of advice you'd give to your younger self about money?
I'd say, actually, I'd tell my younger self to read this book and stop trying to make quick money in the stock market. That's what I tell my younger self.
This is a hypothetical question. If you're given $1 million to invest tomorrow, how would you allocate it?
I'd put it in stocks, but I'm not going to tell you which stocks because no investment advice.
Yeah.
But
yeah, that's fine. Have you ever received financial advice that made you laugh or cringe?
Oh, cringe all the time. And in fact, I mean, that's kind of the reason that I wrote the book is I've seen too many people trying to make money quick in stupid stuff.
Yeah. And I got, what's like one that you like to debunk? Like what's financial advice or what's something about wealth management you like to debunk? What people think, you know.
There is no one best way to manage money. The best investment strategy for you is the investment strategy that you believe in. And so really, this is the investment strategy I believe in. I think it's the best for the vast majority of people. Some people prefer indexing. If they believe in it, go for it. If you believe in Bitcoin, you've done really well in it. I'm not going to tell you that you're wrong, but I think one day you might want to diversify, going back to that wealth preservation. But I really think that you have to find something that you believe in. And, I think there's too many people who they waste time arguing about what the best way to invest is. I love having debates with people about this book. I talk to a lot of people who, don't agree with everything I wrote, and I wrote it that way on purpose. You're not supposed to agree with everything I wrote. And I like having those discussions with people because I find it's interesting. I love the debate, and I'm saying this is what I believe. I'm not saying this is the right answer for everyone.
Okay, perfect. Well, did you have fun? Would you come back?
I'll come back, yeah. You want to be back?
Thank you, Geoff. Yeah, I want you back. Thanks, Geoff. Thanks for coming on to our podcast, and we'll
Thanks for having
see you
me.
later. Oh, again, if you want to buy this book, we're going to have our link in the description for you to buy it off Amazon, and I think there's an audio book, yeah?
No,
I thought there's two options. Oh, hardcover.
There's Kindle and paperback.
Okay, Kindle and paperback. And it's a very good quality books.
And it's not just available on Amazon. You can buy it in any
online
bookstore.
Yeah, any online bookstore. Thank you so much.